In 2021, LVMH acquired a 50% stake in Jay-Z's champagne brand, Armand de Brignac. In 2023, Bacardi acquired a majority stake in his cognac brand, Douce. In 2021, Square acquired a majority stake in Tidal. Jay-Z didn't just sell products, he sold equity, and in doing so, he quietly built a billion-dollar portfolio by repeatedly choosing ownership over paychecks. Before champagne stakes and streaming acquisitions, Sean Carter was already one of the most successful rappers in history. Multi-platinum albums, global tours, cultural dominance. By the early 2000s, Jay-Z did not need to prove relevance. He had already secured it. And that is precisely when most artists make the wrong decision. Because when you are at the top of your craft, the most tempting move is to maximize cash flow. Large endorsement deals, seven-figure appearance fees, guaranteed advances, predictable income, low volatility. But what few people noticed at the time was that Jay-Z was studying something else entirely, not just music contracts, not just performance revenue, he was studying ownership structures. He had watched artists before him earn millions and lose leverage the moment their popularity dipped. He also watched executives maintain influence long after the artists faded, and somewhere in that contrast, a philosophy formed. Instead of asking, "How much does this pay?" he began asking, "What do I own?" That shift would define the next 2 decades, and it would explain why he consistently chose equity over paychecks, even when the paycheck looked larger. The defining shift did not happen in a boardroom filled with venture capitalists. It happened when Jay-Z began turning down traditional endorsement structures. The music industry had a familiar formula: artists lend their image, brands pay a fee, everyone moves on. The artist receives immediate liquidity. The brand receives borrowed credibility, safe, efficient, temporary. Jay-Z began disrupting that model. Instead of large endorsement checks, he pushed for ownership stakes. Instead of flat compensation, he negotiated participation. One of the earliest visible examples was Rocawear. Rather than simply endorsing a fashion label, he co-founded and built it. In 2007, Rocawear was sold to Iconic's brand group for approximately $204 million. He reportedly retained certain rights even after the sale. The lesson was clear: building equity compounds. Endorsements expire, but the real test of this philosophy came later, in industries far outside music: alcohol, streaming, luxury. Each time the choice looked similar on the surface: take the large guaranteed payout, or take equity. One pays now, the other pays later if you're right. And here's the tension. Equity only works if the underlying asset scales. If it fails, you don't just lose money, you lose time. And time, for public figures, is the most expensive currency of all. Yet repeatedly Jay-Z chose delayed upside over immediate certainty. That is not luck, that is a thesis. And the first major escalation of that thesis would come in a market dominated by centuries-old European houses. Champagne. Luxury champagne is not a casual business. It is an industry built on heritage, European lineage, and generational brand equity. Entering that market as a hip-hop artist is not merely ambitious, it is structurally improbable. Armand de Brignac, widely recognized as Ace of Spades, began as a quiet acquisition. Rather than serving as a brand ambassador, Jay-Z acquired the brand outright in the mid-2000s. This wasn't a licensing deal, it was ownership, and that's where the risk became real. Champagne demands capital, distribution, and disciplined brand positioning. Luxury isn't built on volume but perception. If it failed, it wouldn't fade quietly, it would be a costly miscalculation. But instead of flooding the market, he controlled distribution tightly. Scarcity was not accidental, it was strategic. The brand remained premium, selective, culturally visible, yet commercially disciplined. Then in 2021, LVMH, the world's largest luxury conglomerate, acquired a 50% stake in Armand de Brignac. The valuation was not publicly disclosed in full detail, but the transaction confirmed something far more important than numbers. A global luxury house had validated the asset. This was no longer celebrity merchandising, it was luxury equity. The contrast is sharp. Most artists endorse alcohol brands, few own them, and fewer still sell half to LVMH. But champagne was only the first signal. The second would prove that this was not a one-off success, it was a pattern, and the next industry was even more competitive: cognac. Champagne established a signal, cognac confirmed the strategy. Doucet was launched in partnership with Bacardi in 2012. Unlike Armand de Brignac, which began as full ownership, Doucet was structured as a joint venture. This distinction matters. Joint ventures introduce alignment risk, shared control, shared decision-making, shared exit timing, but they also reduce operational burden. Instead of building a distillery from scratch, Jay-Z partnered with an established global distributor. This was not a creative gamble, it was structural leverage. The brand grew steadily, premium positioning, controlled expansion, strategic visibility. Then in 2023, Bacardi acquired a majority stake in Doucet. Financial terms were not fully disclosed, but the acquisition reinforced the underlying thesis: build equity, scale with distribution partners, exit partially, not entirely. Here is the subtle pattern. He does not build for perpetual ownership. He builds for strategic liquidity events, partial exits, retained stakes, maintained influence. This approach creates both capital recycling and portfolio diversification. Contrast that with endorsement deals. An endorsement pays once. An equity position can be monetized multiple times. And yet alcohol is a tangible product. It has manufacturing constraints, geographic limitations, regulatory exposure. The next move would be far more volatile: digital streaming, where margins are thin, competition is relentless, and loyalty is fragile. Tidal would test whether the equity-first philosophy could survive in a tech-dominated environment. If champagne was legacy luxury, streaming was pure volatility. In 2015, Jay-Z acquired Tidal, a music streaming service originally launched in Norway, for approximately $56 million. At the time, Spotify was dominant. Apple Music had entered aggressively. Tech companies were reshaping distribution economics. Buying a streaming platform as a musician appeared counterintuitive. Streaming platforms compress margins. Licensing costs are high. Customer loyalty is low. And infrastructure costs are constant. It looked risky. The execution was uneven. Market share remained relatively small compared to Spotify and Apple. Critics labeled it an uphill battle, and this is where the contrast becomes instructive. In alcohol, he entered established premium markets. In streaming, he entered a hyper-competitive technology ecosystem. The risk profile increased significantly. Then in 2021, Square, now Block, acquired a majority stake in Tidal for approximately $297 million, and Jay-Z joined the board. The asset did not dominate the industry, but it created liquidity, and once again, equity converted into capital. This was not about beating Spotify, it was about positioning ownership for exit, and at this point, a pattern was undeniable. Equity was not a side quest, it was the strategy. But the most interesting move was not in alcohol, not in streaming, it was in infrastructure: Roc Nation. Founded in 2008, Roc Nation was not simply a record label, it was a management company, a publishing arm, a touring division, a sports agency. Instead of negotiating contracts within existing systems, Jay-Z began building the system itself. That is a different level of leverage. Artists sign to labels. Athletes sign to agencies. Managers negotiate on behalf of talent. Roc Nation inserted itself into all three layers. This is vertical integration disguised as entertainment, and it carries higher stakes. Managing talent means reputational risk. Publishing rights require long-term patience. Sports representation invites regulatory oversight. But the upside is durable influence. Rather than relying solely on personal relevance, he positioned himself inside the revenue streams of others. If one artist declines, another rises. If one athlete retires, another signs. The ecosystem sustains itself. This is not diversification, it is architecture, and once architecture is built, exits become optional rather than necessary. At this stage, the philosophy had matured. Equity was no longer opportunistic, it was structural. But there is always a moment in every strategy where risk crystallizes, and for Jay-Z, that moment wasn't financial, it was philosophical. The decision to repeatedly delay large guaranteed paychecks in favor of long-term participation. That is where the point of no return emerges. The point of no return was not a single deal, it was a repeated decision to consistently decline large immediate compensation in exchange for ownership participation. There is a quiet risk in that approach. Equity is uncertain, markets fluctuate, brands fail, distribution shifts, consumer preferences evolve. A guaranteed check eliminates that volatility, ownership amplifies it, and over the years there were moments when the safer option would have been obvious. Endorsement deals worth tens of millions, guaranteed contracts without operational exposure, short-term income without long-term responsibility. Choosing equity repeatedly means accepting delayed gratification. It means trusting scale over certainty. It means understanding that capital today can be consumed, but equity tomorrow can multiply. There is also reputational exposure. When you attach your name to a brand as an owner, failure becomes personal. If Champagne underperforms, it reflects on you. If streaming struggles, it reflects on you. If talent missteps under your management umbrella, it reflects on you. Ownership increases upside. It also increases accountability. And once you build a portfolio around that philosophy, reversal becomes difficult. You are no longer an artist endorsing brands. You are an operator allocating capital. At that stage, you cannot pivot back to transactional income without signaling retreat. The strategy becomes identity, and identity creates inevitability. By the early 2020s, the pattern had matured into a portfolio, Armand de Brignac, partially acquired by LVMH. Douce, majority stake acquired by Bacardi. Tidal, majority stake acquired by Square. Roc Nation, embedded across music, sports, and publishing. None of these moves were random, each followed the same architecture. Acquire or build equity, scale through distribution, exit partially, and retain influence. And here is the structural contrast that defines the outcome. Many artists accumulate wealth through peak income years. Jay-Z accumulated wealth through asset events. One model depends on staying culturally dominant, the other depends on building transferable value. Public estimates have placed his net worth in the billion-dollar range, making him one of the wealthiest figures in music history. But the number is less important than the composition. It is not primarily touring revenue, it is not primarily record sales, it is equity. And equity behaves differently than performance income. It appreciates, it can be leveraged, it can be refinanced, it can be partially liquidated without disappearing entirely. That is durability. The outcome was not a single massive payday. It was a pattern of liquidity events layered over time, each reinforcing the philosophy, each validating the thesis. Ownership compounds, paychecks expire, and by consistently choosing equity over immediate compensation, he built a portfolio that does not depend on album cycles. That is the transformation, from performer to allocator, from brand ambassador to brand architect. The surface lesson is simple: equity outperforms endorsement, ownership outlasts attention, but the deeper lesson is more nuanced. Choosing equity requires patience. It requires tolerance for volatility. It requires understanding that immediate liquidity often limits long-term upside. Most professionals optimize for salary. Jay-Z optimized for participation. A paycheck compensates effort. Equity compensates alignment. When you align yourself with the growth of an asset, your upside scales beyond your time. This applies beyond celebrities. Founders face similar decisions. Take venture capital at lower valuation for speed, or retain ownership for control. Sell early for certainty, or hold for expansion. Accept guaranteed revenue, or build something that appreciates. The most transferable principle from this pattern is not fame, it is allocation. What you choose to own determines what you eventually control, and what you control determines how long your influence lasts. Jay-Z did not abandon paychecks entirely. He simply refused to depend on them. He built a portfolio where compensation followed growth rather than performance. If this breakdown provided some clarity, feel free to like, share, and subscribe to Holistic Tube, because the real stories in business are rarely about headlines. They are about the small daily decisions that seem insignificant at first, but end up being the cornerstones that build empires.